Altria Group, stock ticker MO, took a huge decline over the past 5 days and is down nearly 11%. Now, year to date, this is a company that's down about 3.5%, which when you compare that to the broader market over that same amount of time, it's actually performed pretty well as the S&P 500 is down 22%. Now, something that we do need to take note of is Altria Group at this price is paying over a 7% dividend yield, which makes it an extremely attractive investment to a lot of dividend investors, especially at a time when the broader market is declining and analysts are expecting it to continue to decline. So in this video, we're going to be jumping into my stock valuation spreadsheet to see if Altria Group is a stock we should be buying or selling. And on this spreadsheet, we have 4 different valuation models. We have Graham's valuation, a discounted cash flow model, a multiples valuation, and a dividend discount model. And all 4 of these valuation models will roll into our output tab. But let's go ahead and jump back over to our stock screener. If you'd like to be able to download this spreadsheet, then you can head over to my Patreon page at the link in the description. So the first thing we want to do is we're going to come up here and we are going to plug in Altria Group stock ticker and hit enter, and we can see all of this data is going to automatically fill in. And we're currently looking at a 200-day change, and like I said, they performed pretty well up until a certain point, and they have really declined over the past few months. Now, obviously, if we come over here and look at the dividend, a lot of investors love this company solely for the dividend. It's paying out $3.60 per share. The dividend yield is currently sitting at 7.8%. We'll come back and look at the payout ratio a little bit later in the video. Now, this is an industry that analysts are expecting it to continue to decline, so that is something that we do have to take note of. But the beta of this company is extraordinarily low, meaning when there's times of volatile markets, it's likely not going to decline as much as some of these other companies. Let's go ahead and look at Graham's valuation. And Graham's valuation is a valuation model invented by Benjamin Graham in order to calculate intrinsic value, and this is the formula he's laid out for us right here. So the first thing we need is our earnings per share, which we have listed here for Altria Group. We're then going to multiply it by 7, which is the price to earnings of a company with no growth. And now we need to apply a growth rate projection. And like I just mentioned a moment ago, this company is not projected to grow at a very rapid rate over the next 5 years. So we have our growth rate projection of 5.5 right here. We're then going to multiply it by 1G, which is our growth multiplier, and multiply it by 4.4, which is the average yield of AAA corporate bonds. After we have that, we are going to divide it by Y, which is the current yield of AAA corporate bonds. And at the time of this video, it is sitting at 4. Now, earlier this year, this was as low as 2.5. When we have the current yield of AAA corporate bonds at 4, we can see our intrinsic value is 22.55. If we change it to 2.5 just for comparison, like earlier about a year ago, we can see the intrinsic value actually jumps up to $36 per share. But let's go ahead and switch it back. But we can see just how much of a factor the current market conditions play on this valuation formula. But let's go ahead and jump over to our DCF model now, one of the best ways to value a stock. And in order to perform our discounted cash flow analysis, we need to project a growth rate for the future free cash flows of the company. So in order to do so, I've looked at historical free cash flows for MO, and we can see actually over the past 4 years, they had a pretty high average growth rate, solely due to the really large increase from 2018 to 2019. When we take a deeper dive into this and look at their industry is really not going to be growing at a very rapid rate for the foreseeable future. So because of this, I'm applying a growth rate of about 5%. Using this growth rate, I was able to project forward the future free cash flows for this company and calculate the terminal value, which is the sum of all the future free cash flows past the year 2030. I then took the present value of all these future free cash flows and added them together here. I added the company's cash and cash equivalents and subtracted out their total debt to find what their equity value is. After I got their equity value, I divided it by their number of shares outstanding, and I got a discounted cash flow price per share of $67.36. Now let's go ahead and jump over to our multiples valuation. And the idea behind our multiples valuation is we should be able to value a company using a price to earnings multiple, and it's going to be able to see how the market is valuing similar companies that are similar in structure to MO. So exactly what we're doing is we're taking companies like Philip Morris and Universal Corporation, we're taking their stock price and dividing it by their earnings per share to get their price to earnings multiple. We then take the average price to earnings multiple for these two companies and multiply it by MO's earnings per share to find an intrinsic value using our multiples valuation model of $27.47. Now let's go ahead and jump over to our dividend discount model now. And this is a valuation model that's really important to MO because obviously a lot of investors are into this stock solely for the dividend. And the idea behind our dividend discount models, we should be able to value a company based on how much they pay in dividends and how much that dividend is increasing. If they don't have an increasing dividend, then it's kind of a red flag. But as we can see here, I plugged in the quarterly dividends paid out so we can see how much they pay out yearly. And we can see that the average growth rate for their dividend payouts over the past few years was about 6.58%. So that's pretty decent dividend growth. Going forward, I'm projecting a growth rate of about 5.75%, which is slightly lower than their average growth rate. After applying a discount rate of about 9%, we can see the dividend discount model actually gives us a price per share of about $117, which is much larger than the current price of $46.30. But let's go ahead and jump over to our output tab. And here on our output tab, we can see we have all 4 valuation models: grams at 22, multiples at 27, discounted cash flow at 67, and dividend discount model at $117 per share. So obviously we can see we have some pretty wide ranges when it comes to all 4 of these valuation models, but I do think all 4 of these can provide some value in finding the intrinsic value for this company. When we average all 4 of these together, we can see we come to an intrinsic value of $58.63 per share. When you compare this to the current price, it is above it. The current price is $46 per share, but as a value dividend investor, we do always want to apply a margin of safety. So if we come right here and we apply a 25% margin of safety and hit enter, we can see our acceptable buy price is about $43.97 per share. So our valuation spreadsheet is telling us this is not a stock we should be buying. Now, if you're a little bit more aggressive with your investments and want to apply a 20% margin of safety, you can see the stock is currently trading right at a point where it would be acceptable to buy this company. Now, if we jump back over to our stock screener, we do have to make note of something very important, and that's the payout ratio for this company is far higher than is sustainable. So historically speaking, this is a company that has been increasing the amount they pay in dividends over the last 10 years. But when we look at their earnings per share at 164 and their annual dividend per share at 270, currently Altria Group's dividend payout ratio is 217%, like we saw in our stock screener, which is not sustainable. But I do think there is still some hope for dividend investors who are considering the stock. When we look historically, they have had a free cash flow payout ratio of around 80%, and I do think they can get back to that range. So for me personally, if they can get back to that 80% range with their payout ratio, I think this could be a stock that could actually be pretty attractive with the current market environment. You know, with a lot of growth stocks continuing to tank, this is a company that has a beta of about 0.5, so it's not going to move too much as the market moves. And with a dividend yield of nearly 8%, this could provide some pretty quality returns during a bear market. As for me personally, I do own some shares of this in my personal dividend portfolio. I'm still in the green with this company. I was able to buy in at a great price. I'm not currently looking to add more, but I think if the stock continues to decline, this could be something I consider investing in for a short term. But go ahead and let me know your thoughts on this company in the comments below. If you'd like to be able to download the spreadsheet, then you can head over to my Patreon page at the link in the description. So that being said, thank you guys so much for watching this video, and please don't forget to like and subscribe to the channel.